Welcome back to another Tech Talk from MarketEdge.com, your source for unbiased technical stock research, covering over 5,500 stocks and ETFs updated daily. Last week, we were out with the short week for Memorial Day, but today we're back with David Blake, CMT, here to discuss last week's market conditions and what we should look for as we go into this week. David, how are you today?
I'm doing well, thank you.
Great, let's jump right in.
Okay. As Rachel said, we did have a short week last week, but again, it was a market that just won't quit on this bull rally. We had all the major averages close out the week at new highs. The gains were mostly in AI and semiconductors once again, but we also are getting a big, strong rally here in software companies. And that includes today, Monday, after some comments from NVIDIA's CEO over the weekend, that AI may not be as disruptive to software companies as the analysts are thinking. So that is giving the IGV, the software ETF, a nice boost today. And earlier it was up another 4%. But anyway, last week we had strong tech earnings. We had some mixed economic data. And we also, in the background, we had some hopes for a peace deal. But that seems to be waylaid a little bit today as Iran called off peace talks this morning. So that's causing a little bit of a waver in the markets. But let's go ahead and talk a little bit about last week. We started out with Micron Technology. It was up 20% and had a raised price target by UBS. And that helped the Philadelphia Semiconductor Index jump up about 5.5% to start the week. We also had strong earnings from Marvell Technologies, Snowflake, and Dell, which sent the technology sector up for the week, was up about 5.9% for the period. In fact, Dell's earnings just kind of blew away the AI-related trade. Their AI server business was up 575%. So that gave all the AI companies another big kick in the rear, and it just doesn't seem to be slowing down at all, despite the parabolic moves that we've seen. And we're having some more of that today, even with the market rolling over and oil prices higher. We're still seeing strength in like I say, software and some of the semiconductor names. Okay, after that, we also had some consumer stocks that outperformed. We had earnings from Best Buy and Kohl's, Dollar Tree. They were all up after beating earnings. We did get a little bit of, I forget what the companies came in on Friday that were a little bit soft. I want to say American Eagle was one of them, and I'm not sure who the other one was, but so it wasn't all great for the consumer stocks, but in general, they were showing the consumer remains strong. The higher rates aren't crimping their style. But on the other side of that, we're also getting some analysts and some bank people saying that missed payments on credit cards is coming up to almost a record high here recently. So we'll have to kind of watch that to see how that goes forward. Okay, we also had some economic data that was mixed last week. April PCE, which is the Fed's preferred inflation gauge, it jumped 3.5% year over year, and the core PCE was up 3.3% year over year. So inflation going the wrong way, not as much as people thought. And in fact, I think the headline year over year number for the PCE was 3.8. So it came in a little bit below that. And also in the core, the final number was a little bit below that. So we'll have to watch that. Consumer confidence dipped down to 93.8. Again, higher prices for gasoline dented consumer optimism. But we did see oil actually for the week came down just a little bit. It spiked when we had some new strikes from the U.S. on Iran, but then it nudged a little bit lower going into the weekend and closed around 87.92 a barrel. And that's down 23% from the 1st of April. Now today, with this change in talks with Iran, and oil's up another 4 or 5%. So it's below 90, I believe, still. But when you have these breakoffs in the talk, you will see that going up. But also, Iran said they're going to completely close the Strait of Hormuz, and that again would cause oil prices to continue higher on that. So we'll see how that goes. The rate on the 10-year T-bill settled around 444. Not a lot of action in that. It's going to probably stay a little bit up around that 4.5 area as long as inflation stays where it is right now. As far as the market sectors go, they again were mixed despite the big gains. We had technology, materials, and consumer discretionary led the advance, while on the downside, the energy sector was down about 5%. Of course, that's when the oil-related stocks go down when oil prices slip. So that was something to watch. We also are seeing some rate sensitive and defensive sectors underperform here recently. Utilities, consumer staples, and REITs were also three of the laggards last week. And part of that, you're seeing utilities weak again today. I think you're having some comments out there about these build outs for the data centers, and that's causing a little bit of weakness in some of the utility things. Okay, as far as the technical condition of the market, that remains positive. You have all the different indexes making new highs. Technical indicators are all positive. MACD had a crossing the bullish ground for the S&P 500 and the NASDAQ. The Dow was already positive. You have momentum measured by the 14-day RSI, still strong. It did cross above 70 for the S&P 500 and NASDAQ. That shows somewhat of a overbought market. And then you had stochastics in the low 90s last week also. That signals kind of confirms that we have a little bit of an overbought condition in some of the different indexes. But you kind of have to expect that when you have the S&P 500 up for 9 weeks in a row, it's going to be overbought. So at some point, we'll probably have a couple of weeks here where we get some consolidation, some backing and filling on these charts and see how it goes from that. Now, we also are seeing as the market goes up, a little bit of a pullback in the VIX. That's the volatility index. It fell below 16 last week for the first time since mid-January. And what that's telling you is that traders are backing off on providing downside protection on their trades. In other words, they're not worried that we're going to see a big drop in the market anytime soon. I often talk about the secondary indexes, which includes the semiconductor index and transports and small cap. They continue to mostly outperform the broader market, which is good. You want to see that. But one of the things that we're seeing that does cause a little bit of concern is that we still only have the technology sector reaching a new high. You know, they talk about you want to see a broadening out of the market, which would mean you would see probably 5 or 6 or at least half of the sectors making new highs while the different indexes are making new highs. That shows a narrowness of the current rally that needs to broaden out if we're going to go much higher on that. Now, I understand that a lot of the overweighted big cap tech companies are the drivers of this rally, but they can only drive it for so long before the rest of them are so undervalued and can pull the generals down a little bit. So we'll kind of watch out for that. As far as underlying breadth goes, we are seeing the NYSE advanced decline line, which is one of the few leading indicators that we have in the market. It's close to new highs. You would like to see the Dow making new highs, the S&P making new highs. You'd like to see that confirming that move higher. I think the last time we saw the NYSE AD line make a new high was several weeks ago, which is kind of what we normally will see. That AD line will usually make a new high and then roll over a couple weeks before the market does. You can see this in the market at a glance over here. Here's the AD line. You can also look at these sometimes like you would a stock chart, because they're going to have support and resistance areas, which will confirm your accumulation and distribution of stocks. As you can see, we're getting up here at a new high, got here a new high right here, came down, getting up here to another new high. And today we're losing another 500 or 600 units in that. So it's going to come back down here. And you want to see if it would come back down here and start to break this 570 area, 572 area. That would probably be a negative that would catch some people's attention. Also over here, you look at the new highs and new lows on these charts. The NASDAQ's fine. The NASDAQ is actually kind of broadening out. In fact, for the 52-week highs last week, I think it was on Tuesday, we hit 559 new highs to only 95 new lows. That shows good distribution and good leadership in the NASDAQ. Whereas in the Dow or NYSE, you're only having 104, 112, 115 new highs to about 40 new lows. So that's something also that we would like to see on the NYSE and the Dow Jones. We'd like to see those new highs start to show some expansion if this thing's going to continue much higher. So that's something that we want to kind of take a look at. That we refer to that as negative divergence. And sometimes when you have a parabolic move like what we have, that would be an indication that we're susceptible to a correction. And in fact, most parabolic moves over the years that I've seen usually don't end well. But in this case, whenever they quote say, this time it's different, and it usually ends up that it's not different. And we'll see how long this plays out for a little bit. I'm not saying we're going to have a big pullback or anything like that, but when you have these parabolic moves, sometimes you want to sell, take off a little bit of cash, sell a little bit of into strength rather than wait for the thing to start dropping and then decide to get out of there. Investor sentiment is very mixed right now. The retail clients are still below the historical average. AII saw a 4% increase in the retail bulls, but still a 35.6, which is below the historical average of 37.5%. But then we saw the hedge funds jump up to 98.4% exposed to equities. That's basically all in, which is a little bit surprising because that's actually up 16.4 percentage points than we were the week before. And normally when you're having these parabolic moves, you're seeing the hedge fund guys start to back off a little bit. Part of that may have been that we were getting to some end of the month window dressing, which could mean that they were trying to show in their monthly reports that they own all the stocks that have been outperforming. If we see that pulling back this week, maybe back down to a 90 or in the high 80s, that would be a confirmation that they were just doing window dressing and not jumping in all in with both feet. So this week coming up, we're starting off a little bit kind of wavering with the different indexes. Problem is, again, because of Iran called off peace talks. We'll see how that goes if it leads to more strikes early in the week. But we got some economic data today. We had the ISM manufacturing index came out. It beat expectations at around 55. It's at around a 4-year high. That's strong. Let's see. Starting to wrap up on the earnings. Tomorrow we get Dollar General, Palo Alto. Later on, we have Broadcom, CrowdStrike, that kind of thing. And then on Wednesday, we have ADP labor employment report coming out. We'll see how that goes. The jobs market still seems very resilient. Even despite these companies announcing layoffs, they don't seem to be doing that. Initial jobless claims stay at around 200,000 per week. We're not seeing much movement in that. And even with continuing claims, they're not showing much movement either. And then on Friday, we get the Bureau of Labor Statistics. They're going to release their jobs report for May. Right now, they're looking for about 90,000 new non-farm payrolls, and that follows last month's 115,000 in April. So that's, again, not a lot of movement in that. That shows that we're not showing a lot of expansion in payrolls by any means, but it's holding steady, and that would keep us right around a 4.3% unemployment rate. So those will be the things you want to watch for this week. Again, we have a couple of big caps coming out with their earnings, most notably CrowdStrike and Broadcom, and we'll see how that goes. But other than that, I guess the market's susceptible to a larger pullback if we would start to see the strait gets completely closed up or they start dropping mines and stuff in the water. We'll see how that goes. That would probably shake things up. It would definitely stop the parabolic rise in the market. But other than that, I think that you just be patient. If you have some stuff that has gone way up and you look at the overbought readings, that doesn't hurt to sell into strength. Our CTI is negative. We have a bearish posture on that, which would probably be more neutral. However, I do think you're going to start to see, as the summer rolls on, probably closer to July, I think you're going to see more weakness in the cycles. And as some of the longer term cycles will begin to exert more downward pressure on the markets. We'll see how that plays out. And other than that, I think that's about it for what we have coming up for the week.
Sounds good. Thanks so much, David. If you'd like more information on technical analysis on over 5,500 stocks and ETFs, check us out at MarketEdge.com. Your first 2 weeks are free. Don't forget to like and subscribe if you enjoyed this video, and we'll catch you next week.